CBI grilled her over the collocation scam. What is the NSE collocation controversy all about?
When the NSE scam broke out for the first time in early February this year, the news started garnering attention from all over the world. And as pressure started mounting from all corners, CBI had to finally close in on its investigation into the collocation scam, which had been going on for several years now. So, in this video, we are going to know what was this collocation scam all about and how did it manage to escape the regulator's eyes for so many years. Let's get started. In order to understand the NSE collocation scam, we need to first understand what does a stock exchange do. A stock exchange is an organized platform or marketplace where buyers connect with sellers and trading of stocks, bonds and other securities take place. After an IPO, companies list their shares on these exchanges and make their stocks available to the public for both trading and investment purposes. So while stock market refers to the aggregation of buyers and sellers who trade in stocks, stock exchange refers to the infrastructure that facilitates such buying and selling of shares. In India, we have two exchanges, the NSE and the BSE, and both these exchanges have majorly four sources of income. First, transaction charges. This is the charge we investors pay for every transaction of ours through NSE or BSE. Second, book building fees and listing charges. Say today TMM wishes to raise an X amount from the capital market, so for that we would first need to get TMM listed in the stock market, right? And for this listing we would need to pay a listing charge to both the exchanges. The exchange also helps companies determine the price at which their IPOs should be offered, and for this service they charge a book building fees. The third source of income for NSE is selling intraday and historical market data to software companies who need this data to keep their algorithm updated. Now, the fourth source of income is collocation facility charges, and this is where the entire collocation scam took place. So, collocation facilities are these dedicated spaces provided in the NSE building where stockbrokers are allowed to place their IT servers right next to NSE's main servers in exchange for a fee. And this service wasn't available until 2009. It was only in August of 2009 that NSE decided to offer collocation facilities to stockbrokers who were willing to pay extra fees. Now you ask, why this collocation facility is so important? The proximity to the NSE main server meant the prices broadcasted by NSE's trading system would first reach those brokers whose servers were closest to NSE servers and then to the rest. Thus you see, giving an unfair advantage to certain brokers only, as these non-collocation brokers would then receive the stock prices with a lag, which would be anywhere between a few milliseconds to a few seconds, when even a split second faster access is considered to result in huge gains for any stock trader. Interestingly, NSE introduced this collocation facility without SEBI first putting up a discussion paper on the subject, as is usually the procedure. Anyway, with the collocation facilities being extremely close to stock exchange servers, certain brokers got an advantage over other brokers due to this reduction in time taken for their order execution. Some players who had their servers located in these collocation areas would jump the queue and buy the share or dump it before other orders were executed because of course, their proximity to the NSE's main servers. Now, things started going worse when in 3 months' time in December 2009, NSE started offering its collocation members tick-by-tick TBT data on the stock price feed. Think of this as being able to watch the coverage of a cricket match ball by ball instead of only getting to know the score at the end of each over. So, how did this tick-by-tick data benefit brokers? It would allow a broker to see every single buy and sell order in the system waiting to be executed. Say a stock is trading at Rs100, while a regular broker could see the best buy and sell orders from the range of Rs100 to 98, a collocation broker was able to see every pending order even more granularly. Moreover, say a regular broker could see cumulative buy orders of 10,000 shares at a certain price, the collocation broker could view every individual bid. He could see that there is a single bid for 5,000 shares, 10 bids for 100 shares, 3 bids for 250 shares and so on. And there is more. The co-location broker could also see every single order modification in the order chain. For instance, a buyer may decide to lower his price bid, so he will still be in the system but at a different price point, right? So while the regular broker might assume that the order has been cancelled, the co-location broker knew that the buyer has just moved a few rungs down the ladder but is very much interested in buying. This knowledge of the depth of the order book and price points maximum buyers and sellers were at helped certain brokers manipulate the stock prices and game the system. You might think that okay, but all the co-location brokers with access to the TBT data would have the same advantage, right? Here's where the game becomes more interesting. Remember while in the checkout queue at a supermarket or in the check-in queue at the airport, we're always trying to figure out which line would move faster. But what if you knew beforehand which queue would clear the fastest? And this is what some brokers were able to do. How, you ask? The NSE data was being distributed to brokers through the TCP/IP architecture. Without getting into the technical details, the flaw in this architecture was that the data was being distributed on first-come, first-served basis, meaning even among the co-location members, the broker who would log on to the server first would stay in the front and could have the first shot at every trade for the rest of the day. Now, because the servers were not started at the same time every morning, a broker who knew which server would be started first would latch onto that server. And some brokers did just that. They were able to successfully exploit this loophole with the help of a few NSE officials who were managing the system. They'd also figured out that there was an advantage in being on the server with the least load, that is, the least number of trading members logged onto it, because that way their trades would get executed faster than those who were logged onto the crowded servers. But soon after receiving complaints from many brokers about this flaw, in 2012 NSE introduced a load balancer in their server, whereby the orders would automatically be allocated to the least crowded servers. And by 2014, the NSE implemented the multi-broadcast TBT protocol. As the term broadcast suggests, the data feed would now be distributed simultaneously to all the co-location brokers instead of the earlier first-come, first-served basis. Hence, there was no longer any advantage in logging in first. But you would be surprised to know that even that did not fix the problem, as the smarter players still managed to game the system. How? The load balancer did ensure that the orders were automatically routed to the least crowded server. But, NSE also had a backup server to which the co-location brokers could log on if there was any trouble with the primary servers. And this is exactly what the few brokers took advantage of. They started accessing these backup servers regularly with the help of data center staff, even when the primary servers were working fine. And since these backup servers were with zero loads, they provided far better and faster access to the stock price data in comparison to the normal servers. This exploitation of the system continued on NSE's platform from 2010 to 2015. It was only in 2018 that CBI first got alerted about this alleged scam through a whistleblower. And soon it was found out that the broker to have received the maximum benefit in this scam was OPG Securities. While investigating later, CBI also found out that a man named Ajay Narottam Shah had collected NSE's trade data in the name of carrying out research and later on passed it on to a few private persons who developed a software named Chanakya. This Chanakya software was then sold to selected brokers like OPG Securities, who benefited immensely from exploiting the TBT architecture of NSE using this software. According to whistleblowers, the players with this advantage were easily making between Rs 50 to 100 crores cumulatively every day. That's how big the scam was. We've talked about the recent NSE Himalayan Yogi scam in this video. I will share the link of the video in the description, so do check it out. And for more such interesting financial news and business case studies, do subscribe to our YouTube channel, The Money Master. Until next time, namaste, bye bye, and take care.